Top of the morning to you. Welcome to the Flow Show. It's Wednesday, halfway through the week already. Good stuff. Morning, Kay. Morning, Dale.
Morning.
Morning. Happy Helping Day.
How you doing, everyone?
Yeah, very good. Very good. All good.
Good. Hope you got some good recipes to discuss on today's show.
Mate, there's absolutely nothing happening. I don't know what we're going to talk about, but yeah.
We'll see.
Yeah, well, there's always something to talk about. We'll make something.
Fill an hour with a load of nothing. You will see.
Yeah. Football's on. We should delay the Flow Show in between the football.
Yeah, the football's on, and I'm shit scared about what the referee is going to do tonight. It's the Zambian friend who stopped the game 5 minutes before time because so-called he heard a call from God that he had to stop the game.
Jesus. Was it Jesus actually, or was it another?
I don't know what it was actually, but I mean, I'm already scared about what is going to happen tonight.
Yeah, well, good luck. A big calendar on the football anyway. Spain, Germany, Belgium all playing. So yeah, it's going to be a good day. Good day. Right, well, let's get into it because there are some bits and pieces to go through. China, the COVID situation isn't getting any better. In Shanghai, there's now a ruling for people who have stayed there for less than 5 days and not allowed to enter public places. In the Haizhou district, which is part of the Guangzhou city, they've extended COVID measures in some areas out to November the 27th. In the Chengdu area, they will conduct mass COVID testing from the 23rd to 27th of Nov. Beijing has urged residents to reduce the movement to curb the COVID spread, and they're asking the residents not to leave the city unless completely necessary. Now, the one thing we're not getting at the moment is huge lockdowns. It's all, take caution, be careful, reducing some movement. Obviously, we don't know exactly what's going on the ground, but as far as the headlines are going, we're not hearing of big mass lockdowns and so on and so forth. So maybe this is the difference between COVID policy now and COVID policy previously. Over to the PBOC, and there was a PBOC advisor, Wang. He was out last night, early this morning, saying that he sees limited room for the PBOC to cut interest rates, but that a slower Fed hikes in H1 2023 will raise China's policy room. I was expecting $1 to maybe react a bit on that. We've been speaking the last few days about the PBOC and whether they might be moving away from their easy policy, not wholesale, but we had those comments a couple of days ago where perhaps rising inflation may start to take precedence over their policies and whether they continue to ease. So this policy advisor is saying that there's limited room for them to continue easing, and they haven't cut any of their rates over the last couple of months. So maybe they are at least on pause. I was expecting maybe the yuan to gain a bit on that, but it hasn't done an awful lot. Still sitting in that, call it 7.10, 12 to 7.19 range at the moment. So not a lot of movement there right now, but potentially we might see some moves from China. Over to the RBNZ, they hiked 75 BPs to 4.25%. Quite a hawkish meeting in the end. Governor Orr said that he expects a shallow recession, but that the committee spent more time considering 75 and 100 pip hike than a 50 pip hike, and that they are very eager to get the OCR to its peak. And they raised the higher peak to 5.5% in 2023. So it's still 125 points above where we are now. But that's where they see the cash rate rising to. And as far as all's concerned, they're very eager to get to that peak. Some of the banks are out picking numbers out of the air. ANZ now sees them raising the OCR to a peak of 5.75%. So that's above, well, at least above the 2023 forecast from the RBNZ themselves. Either of you two up for the RBNZ last night?
Of course not. It's like past midnight my time, so yeah.
Yeah, so a pretty hawkish sounding meeting, but we haven't made any new ground. Can't get above that 62 area in the Kiwi. So once again, it's as Kay was mentioned, might be a bit of a buy rumour, sell fact on that hike. The market was expecting 75 pips anyway, so no real shock there, and has not taken much on the hawkish side. But then if we look at Aussie Kiwi, that's doing a bit better on the Kiwi side, at least since the meeting. But as you can see, they're a bit of a chop around in the pricing. What are your thoughts for that one, Kay? Is it the usual case where we've had the news and now it's back to everything else? Or do you think the Kiwi's going to stay a bit stronger for a while?
Yeah, I wasn't up either, and I haven't read too many comments, but or is again data dependent, it seems. Then he had this line about saying new shocks are arriving all the time. I don't know, is he trying to be the new polos also? I don't know. And then he said also we are mature in our tightening cycle. So that's probably holding back the Kiwi dollar from making too much of an advance. But then if you look at the Aussie Kiwi, as you say, there's a clear divergence between what the RBNZ and the RBA is doing. And I think it's just a case of the weaker side might still be a bit lower on the Aussie Kiwi. And now we're going back to real data watching, in my opinion. So yeah, perhaps that the biggest move in Aussie Kiwi has been done, but yeah, we can't rule out that we are going to find rally sellers. There's decent resistance now between 108.5 and 109 on the Aussie Kiwi. So we're about 1% away. Any retest there is going to tell us whether this move is done over and out, or we're going to continue now. And ideally, we should see a retest, and then we know what's happening. But first of all, as I said, the weak side still looks to be the downside, because they are now clearly diverging the two central banks.
Yeah, it may be if the RBNZ are picking up the pace they want to get to their peak quickly, it could mean we see this this pair much weaker, and then that might provide a good buying opportunity when they catch up.
Yeah,
okay.
I mean,
just take it for a second.
So yeah, okay, mate. Okay, let me go on to the let me go on to the where am I?
You are in the UK.
Yeah, on the new screen. Do you guys
I'm still seeing Ryan's screen. Oh no, starting screen sharing. I can see, yes, the data, the investing.com calendar.
Okay, yeah, that's the one I wanted to be on. Yeah, so the last bit on this RBNZ is that indeed we may see another leg lower because the divergence on the central banks. But from here, I think we should really start to look at real data again.
Sorry about that.
No problem. Do you want to take it over again? I was just going to go over the numbers that were out.
Yeah, I can take it back if.
Yeah, sure, mate. Just grab it.
I had a delivery that was, of course, scheduled for right bang in the middle of the show.
Yeah, just grab it, mate.
Yeah, no worries, mate. There we go.
And while you're grabbing it, there was this question, and while we run this Kiwi and Aussie Kiwi question from Charlie asking about the RBNZ, the Aussie PMI, China COVID, etc. On what we thought about it. So I think, Charlie, we've answered most of it yet. Yeah, the Aussie PMI came out just a tad better on the manufacturing. No, it's still above 50, let's put it that way, on the manufacturing. but then a weaker one on the services. So I guess that hasn't helped Aussie Kiwi as well. Either, I should say, and well, that's probably one of the main reasons we are here. The China data, we've already discussed that in the past. China COVID situations, we've had an impact on the Aussie from it, like a slow grinding impact perhaps, but really the market hasn't been trading that much on the Aussie in regards to the actual Chinese COVID situation, in my opinion. It's more coming straight into, we're seeing it straight into the CNH right now. So
yeah,
just to reply on Charlie's question.
Yeah, thanks, mate. There's also been a half comment I caught that China and Australia are going to be maybe having a chat on military matters. That's been a bit of a function that's going on amongst defensive people in government, they're all speaking, and Australia and China may get around to speaking again on defence matters, which there's been a bit of friction between China and Australia over the last year or so. So any signs of thawing there is potentially a boom for the Aussie dollar, you know, because obviously China is one of their biggest customers. So that's something, if it develops, to look at as well. Right, get into some of the other headlines. There was a Reuters poll on the Bank of England, and 43 of 56 economists say the BOE is going to raise rates by 50 BPs on December the 15th. That'll take us to 3.5%. 13, the balance said that they're going to raise by 75 basis points. And economists expect the BOE peak to be at 4.25% sometime in Q1. Still probably a little low for my liking, but that's where the expectations lie for the Bank of England into December, and we'll keep an eye on those rate odds. Just before the show, the UK Supreme Court ruled that Scotland cannot hold an independence referendum without government approval, UK government approval. That's a bit of a blow to the Scottish leadership there. I had a look at cable, and I didn't think there was going to be much reaction, but I'm not sure if there was in the end. There was a little bit of a lift up. We got a bit of a lift round about when the data dropped, and then a bit of a secondary bounce up there when that news headline came out, knocked us up into the 1930s. I wasn't expecting this to have any major impact on the pound, but now it's out there, it seems that some are taking it as a positive sign that there's potentially not going to be a split in the UK, and all the mess that will bring. I doubt we've heard the end of the story. The Scottish leader, who we nicknamed Jimmy Cranky, has already been out saying that it strengthens the case for independence, that the UK courts rule against Scotland, blah, blah, blah. But anyway, that was a potential effect from the Scottish referendum. Over to the ECB, and ECB Simca says that a recession on its own will not solve the inflation issue. Still in this crazy world where they think crunching the economies to contain inflation is actually a monetary policy tool. But there you go. And that the ECB will continue to raise rates after March if needed. Then it said it's too early to pick the next hike without the new forecast. Well, we might have had some help from De Guindos, who came out after that to say that upcoming inflation data projections will still be high before starting to slow down in the first quarter of 2023, and also that core inflation will still be high too. Now, for those that may not know, De Guindos, when he was Spain's economy minister, was very good at coming out a few days before Spanish data or forecasts and tipping a nod to what was going to happen. So he's basically, as far as it looks like, they dropped the ball that the inflation projections are going to be going higher when we get the December forecasts at the December ECB meeting. Now, we've already heard that ECB's Lane pretty much, as far as he's concerned, has ruled out a 75 pip hike. And why that's important, because he's the ECB economist, he actually sets the tone for ECB meetings. So what happens at these meetings is they all gather around. ECB's Lane puts forward proposals of what to do at the meeting. So he basically makes it up, his view of what they should do. Then everyone discusses on it and vote on it and whatever, and then they take the decision from there. But it's largely led from Lane putting forward the idea for the decision. Now he's pretty much been against another 75 pip hike. Doesn't mean it's not going to happen and we can't get one. I think it is a strong case that we do get a 75 pipper, but as far as he's concerned, he's putting down a 50. But that needs to be married off against what these projections show. If they show a real steepening in inflation expectations, that could tip the balance for some ECB members to go to 75 BPs. But it does show what sort of a farce it is, because Simkus is saying he's waiting for the forecasts, and there's De Guindos saying he pretty much knows what the forecasts are anyway. The rest of us just sit in the dark like mushrooms fed on bullshit. Right, sticking with Europe. And if you want to laugh, the European Commission is apparently going to propose a gas price cap. Oh, they're going into action. And the cap will be at 275 euros per megawatt hour, with a little exception, that the cap will only be a cap if that price is breached for 2 consecutive weeks. So not really a cap at all. Work that one out. It's only a proposal. There's been lots of bum fighting about it so far. Expect that to rumble on, but only the EU can produce a cap that isn't really a cap. Right, let's have a quick look at some of the data before we go into some of the news. As Kay mentioned, PMIs from Australia came out a little bit softer, services much softer, pretty much a theme we've seen all morning. But going back to yesterday, there were some numbers out. Eurozone consumer confidence, I told you it was going to be a negative number, and it came in at minus 23.9 from minus 26 prior. Sorry, minus 27.5 prior. So things a little bit less crappy in the Eurozone than they were previously. Calendar retail sales out there a little bit on the soft side. Core sales, that's ex autos, down 0.7%, a bit worse than 0.6 expected. Retail sales headline, as expected, minus 0.5%, bit lagging. It's for September. We also got the Philly Fed Services Index, which still to this day, I don't know why, is not on a lot of calendars. It just pops up when they feel like it. That was down 13.6, not as bad as the down 14.9 prior. New orders were a bit worse. Employment dropped to 10 from 13.3 prior. Wages and benefit cost index was down a bit, 41.5 from 49.9. So again, soft numbers from the service side of the economy, and also that's been followed up by the PMIs that we're getting today and have seen in Europe. And we'll take a quick look at those. So the PMIs in Europe, all still in negative territory. Bar the odd one. French manufacturing, bit better, 49.9. Services, again, worse than expected, 50.6, and going into contraction. Germany there, still in contraction, not as bad as it was last month. Same pretty much for the UK, bit of an improvement, but still all in negative territory. Likely we may see that continue at least into the end of the year, but we'll watch that. US stuff later on today. We get quite a bit of data actually. Building permits, that's a revision there. MBA, and we also get durable goods, jobless claims because it's the holiday tomorrow. And what else do we get? I think we get the Michigan consumer sentiment and the S&P Global manufacturing PMIs, the flash numbers from there. So quite a bit of data to look at. Oh, and new home sales as well. They're shoving it all in because obviously we've got holidays tomorrow. And just to let you know, it's an early finish in US markets tomorrow and also Friday. What else have we got? Oh, there's still a few more headlines to go. Right, Fed's George was taking a different slant to talking about rate hikes, saying that as they tighten policy, the dynamics of excess savings is going to be a key factor for the economic outlook, and that higher savings could provide further impetus to consumption. But it could well take a high interest rate for some time to convince households to hold on to savings. So why is this important? This is important because savings becomes a feature of economic activity. If people think that prices are going up, then they tend to spend now to save themselves, not spending more later. On the flip side, if a country's heading towards economic problems, maybe a recession, people tend to save more. So then that lowers activity as well, but it's suggested that that activity is pushed further out. When the purse strings finally get loosened, people get spending again. So it can make economic activity quite, I wouldn't say volatile, but a bit up and down. You get a drop off, you get a snapback, a drop off, a snapback, rather than a smooth level of spending. So that's one area that George is looking at, the savings aspects there. That was obviously a big feature through COVID. A lot of people saving money. In a recession, we need to see if that gets spent or not. And onto the oil trade. And you can tell some of these US bods have never traded in their life. The US envoy Hochstein said oil prices are still a bit higher than they should be, and the US will be opportunistic on the SPR and will look to immediately repurchase oil when prices are in the $70 barrel range. Okay, what would have happened to you and you, Stel, if you'd have publicly issued your buying intentions?
Yeah.
Yeah, you'd have fallen foul of the regulators, no doubt.
Exactly. Yeah.
But apparently, if you're in charge of the US SPR, you can do what you like. But anyway, we know where his bid is, and we can all be 10 cents above his level, $70. Could be we see that level given how oil's performing at the moment, and if China issues keep mounting, that's going to be negative for commodities and oil as well. Right, that's it on the headline front. You guys got anything you want to throw in the pot?
No, absolutely not. There's nothing else going on, right?
I love it when you don't back me up. Right.
No, well,
Okay.
I mean, the only thing is upcoming tonight is besides everything that you mentioned, are the Fed, the FOMC minutes to crown the day. Market is going to look for possible hints at how long the rates will be held up, how quick they might pivot, but I don't know. It could be turning out to be a non-event. Hopefully, it gets the market moving a little bit, but perhaps the combination of all the data that we have before will be a bigger market mover than the Fed minutes.
Yeah, definitely. We spoke about the Fed minutes on F.A.C.E earlier this week. It usually is passes under the bridge without a fuss, because we have heard umpteen times from every Fed member. But yeah, I think any comments on the ceiling, the rate ceiling, and how long they're going to stay high for. But I think they really need to be some explicit comments rather than the waffle we've heard already to ram home the Fed's message. I still think the key day is going to be Powell next week on the 30th. He's speaking just before the Fed blackout for the December FOMC. So he may want to slam a message home. And I suppose we should keep an eye out for our mate Timmy Leaks in case he drops any bombs before Powell, and or even our new one, Jenna Leaks. I'm going to keep an eye out for her as well.
Who's that? Jenna
Oh,
Leaks?
there's our new one. I've tipped the nod. I've let her name out of the hat.
I didn't know that.
There's a new possible Fed whisperer we've been monitoring. We'll keep an eye on her as well.
Okay.
Right, let's have a look at some prices then. And again, not an awful lot to get our teeth into. It's mainly been a bit of dollar weakness, at least yesterday. Got the euro shifting up a little bit higher. There we go. Just off those lows down towards the low 102s, got into the 103s, but it's really a go nowhere situation for a lot of pairs at the moment. All having a breather. Call it the football, call it the run into the US holidays, call it what you like. There's really not an awful lot going on. But what can we do in these situations? I don't want to spend the week saying the same old thing that there's nothing going on. You know, it gives us an opportunity to at least reassess the charts, see the ranges, pick the shorter term ranges perhaps that you can trade between. You know, if you're picking something like Aussie dollar, we've got the zones up here, can't get through the zones, well, then you know how to trade it. If you want to be scalping shorts off your support and resistance areas, look for these smaller areas that are in play while markets are quiet. And there is something to be aware of if we're going to have the US off for basically the next 2 days from tomorrow. There is going to be a liquidity drop. Look for any outside moves. Sometimes a headline can drop that may not mean much in normal times, but when there's a bit of lower liquidity, it can have an effect of pushing prices a bit out of sync. Sometimes that gives you a bit of an opportunity to jump in and have a little scalp on that. Euro sterling, as mentioned, we got up towards the 87 handle, pretty much nailed it. Couldn't break through it, couldn't get through this 87. This is the area 87, 15, 20, call it. And now we're back in the zone. We did have a little move out, but it didn't last. I think if we move out again, we're possibly going to see it down to maybe the low 86s, maybe touch that handle 85, 80, 90, something like that. Again, if that's looking for a scalp, these are the sort of areas you're going to be looking at to maybe get in. For me, it's just about managing what I've got. And as mentioned earlier, $1, still looking at this one, still waiting potentially for a break up through 719, 720. A lot to do on the China situation. But as I said earlier, them maybe looking at halting the easing side of their policy will take some of the steam out of potential one weakness there. Kay, I noticed you're in this one too.
Yeah, I'm a little long, and this morning I sold a bit here, a part of it out in the 716 zone. It's still pretty. How shall I say? Pretty simple, right? Pretty binary. Either China stays closed or they reopen, and it seems that the reopening is going to be a lot slower than we thought, and therefore I think the dollar yuan still has the possibility to get back up somewhere in the 720s or so. It's rather an opportunistic trade, watching developments on restrictions and closures over there. So, and as I was saying at the beginning of the show, it's cleaner. This one is cleaner than to trade the Aussie on the back of China, for instance. That in my view. So it's a bit of a cleaner trade, and it's also got cleaner because we held on just above 7, and so it still makes the area, the zone around 696, 7. The figure is going to be mega important, as I already showed a couple of times. But as long as we hold already 7, this is it looks very clean, right? Okay, if you look at it, technicals may say, oh, we might be in starting a head and shoulder formation with the first shoulder top line around 724.5. Well, if we get up to 724.5, I'll be a happy camper. That's 1.5% move from where I re-entered, and that's pretty cool.
And
so
one of
what happens if we get there?
Yeah, one of the good things about trading this pair, why I like trading it so much, is that you can often get such clear signals from officials, and they will, potentially put in bottoms and tops in this pair. And if you can catch a signal like that, if you catch a headline when they do something like that, then you've gives you a real bias on how to trade it. If they come in and say one weakness is not going to go on for much longer, you know you've probably got a top in around 719, 720. Then you can flip a trade around into shorts and sell the rallies and do stuff like that. So it's a good one to trade official comments. I think, like you say, more cleaner than maybe some of the other central banks when you trade them, because you know you get 30 Fed speakers a week. They can chop it all over the place. Do you want to take the screens, mate, and have a little ping around?
Yeah, if you want to. Again, I don't have masses to show, but first of all, let's have a look on on what happened overnight and what's going on that Aussie Kiwi. So as you can see, Aussie Kiwi has already started to come off quite a bit. Got another knock on the head when RBA only raised 0.25%, and then as the expectations for the RBNZ went higher and higher, it's got sold off again. So to me, this is the level here that I showed before. This zone 108.50, 108.80. Add 109.20, but that's a bit further away now. I think it's really going to be a case of the 108.50, 108.80, 80.90 zone in Aussie Kiwi. If that breaks back higher, there's a possibility to get back into the 110s. But for now, it is still looking pretty ugly, and we may be in for a retest here of this line, which is around 106.70 today. So that's a possibility. There's a bit of 107.40 here as a 61.8. So that should be respected as well. There's a few levels coming into the neighborhood now. So if ever you think it's overdone, or if ever we see some discrepancy between the Australian and New Zealand data, where the Aussie data are slightly better than the Kiwi, this zone may be enough for now. We've done a big move, but catching a knife right here and now, I don't know. The divergence between the RBNZ and the RBA is still relatively big, and don't forget that if you buy stuff like this, you're going to pay for the carry overnight every day. So that's for the Aussie Kiwi. The Kiwi, as Ryan already showed, Kiwi itself, Kiwi dollar, still have to overcome this 62 figure 5. If that goes, then we probably push a little further. On the downside now, the first level that we trading right above on the short term is around here, this 50.55. I think the better zone is 61.20 if we get a bit of a reset, but yeah, it could mean that we are back into the flag and then going back to the underside. If really we start to come off, if the dollar picks up steam again, still 60.60 where we held the last time, that's going to be an interesting level to watch before. But if ever we start to break above 62, then this 62.30, 62.70 area should be within reach. On the rest, really, yeah, this triangling cable, depending where we put the line, we are above now, above this little triangle. This longer term trend line is a different one, but we are above the triangle. We held it pretty cool yesterday, and then started to move higher again. Watch the 119.05, and if we take it from the top, then you have to look at 118.70. So we have two levels now on the cable, 119.05-ish, 118.65-70, call it. That should come in already as a support. And actually, if you look at the price action, that's where we have seen support since yesterday. So if we get back above, if we stay above 119.5, 119.90, and then the prior high 120.25, It will depend on the US data, I think, this afternoon to see if we can really push higher. What lies above if really we start to push higher? There's 121.70. I don't know if cable really cable really has the potential to really go and stay above 120 right now, providing the dollar data don't weaken materially. There's another one that I'm keeping on my radar concerning the dollar yields. This is a daily chart on the dollar yen. So today the bottom of the cloud is around 140.80. This is not too far, and then you take another one here at 140.30 prior lows, 140.25. Those should be two levels to watch now to the downside. Then if you go on to the shorter time frame, 141.90, 142 the figure. I think it's more on the dailies as well that I had this. Yeah, this channel that capped yesterday, 142.10.15. That really is the level that we should watch out for on the top now, going into this afternoon's data. Ahead of the Thanksgiving. So 140, what did I say? 140.70, 140.20.30 on the downside, 142.10.15 top side. That's where your boundaries of this little range lie right now. And going into this afternoon's data, those are the levels that I will be keeping an eye on. Oil is coming off again, and we've seen the Canadian dollar coming under a bit of pressure on the back of it. We've had this move. I thought there would be a chance for this EuroCAD to go have a revisit of the downside of this little channel, but no, this is Euro-Aussie. Sorry, I want to have a look at the EuroCAD. Okay, I thought EuroCAD was going to have a look back into the 136s, but we're knocking our head rather at the top side of this. So if oil continues to go higher, we have to be a bit careful. So I've put my rather bearish view into the drawer for now, and I'll be monitoring what's going on oils. For the rest, really, it's up and down, up and down. If we look at the metals doing exactly the same, failed around, couldn't get to the 1800s, and as we already many times showed, 17, 25, 30, that's where gold should find support. If not, we could correct lower. Silver, idem ditto. Went back below the trend line, knocked our head a couple of times against it this week. This is really the 30, 40, 45 zone. The 200 DMA is still hanging around there as well in silver. This is where we have to go through to get going again. Do we have the strength? Perhaps on the US data this afternoon. And really, that's me done, Ryan. I'm not really watching too much right now. We'll see over the data if there's anything to do.
Yeah, thanks, mate. Alan just asking a question there. Will data move markets this afternoon, or are traders waiting for the FOMC positioning? I think there's a few things in the mix. Let's just have a quick look at the data. If I had to pick it, I'd say for market moves, probably durable goods in the first instance you want to have a look on, in case there's any big variations there, positive or negative. That could be a mover. Look for something like the core durable goods number as well. That strips out some of the big ticket items like defence and aircrafts and things like that, although it's split there as well. So look at durable goods, because when you look at things like white goods, washing machines, that's the sort of thing that comes into durable goods, give an indication for retail sales, that sort of thing. Apart from that, I think the PMI, the S&P PMI flash numbers for services and manufacturing is a potential market mover as well. Is manufacturing expected to hover right on that 50 mark, which is the level between expansion and contraction. Services already in contraction. If that dips further and we see manufacturing going into contraction as well, by a big variation, I should think that's probably going to put some pressure on the dollar. The Michigan numbers a bit later on. Look at the inflation numbers, but it's the final reading, so there shouldn't be, touch wood, too much variation there. And the new home sales, maybe again, if it's a big number, variation either side of that. But I think that's probably going to be one of the last moments we get some moves in the dollar. I think, yeah, there's one eye on FOMC and pound next week, but also we've got the holidays tomorrow and Friday, and I think, you know, a lot of US is going to be off, so there's going to be a natural liquidity drop, and because of that, I can't see a lot of people getting into any big trades or fresh trades going into tomorrow, particularly on the US side. So I think it's just generally a quiet week. You've got to be careful in times like this. As I said, you've got the low liquidity issue where a headline can drop and move the market more than need be. But also, if you're looking to trade, if you've got your levels, have the patience to wait for levels. What you don't want to do is get stuck in a trade in the middle somewhere just for the sake of trading, and you're spending, you know, 6 hours, half a day watching the screens do nothing, or it goes slightly offside and you spend a day watching a trade offside. It is a time to practice patience. Pick your levels, trade your levels. Don't get caught out in the middle just trying to chase a trade because you're bored. That's when you lose money hand over fist. On the prices front, Gavin was looking at pound CAD. Looks a pretty similar picture to most pound pairs. You could probably overlay that on top of the cable chart, and exactly the same picture. What sort of levels are you looking at, Gavin? I know you say it's getting back into a previous weekly range. It's undoing a lot of the work it's done in 2022. I've put the fib on there, but I'm not overly keen on it because of that spike lower. I'm probably more likely, if I wanted a proper true reading, would have the fib go into that area, because that would be more of a real price point than this one down here, because that was obviously the trust quartane spike low. So if you wanted to look at fibs on a more better basis or more solid footing, I'll probably take it from the next low that we got there. But yeah, looking, as I say, pretty much like most pound pairs at the moment. So can it continue going all the way higher, all the way back to the highs in 2022? Remains to be seen. A lot of it's going to be driven by, as usual, what happens in the buck. You're looking for over 160s. Yeah, I think that's doable. But as I say, I think that there's still a big risk for me. The big risk right now is the dollar. I still think the dollar has some upside. I know Kay's mentioned it, that he's more positive the dollar this week at least. I think there's going to be a dollar run higher to come, and that obviously is going to affect things like cable. And it just depends whether pound pairs like this are going to follow on the dollar side or the pound side. It's a bit messy, but you got your levels, mate. You go ahead and trade them, and many pips to you. And on that note, I think we'll call it a day. Not much more to go on about. Bundesbank was just out with their report saying that they see inflation potentially standing double figures over the turn of the year. If that's the case, going to keep the ECB on the front foot as far as height goes. Anyway, thank you very much, Kay. Thank you very much, Dale. Thank you very much to all the viewers coming to the Flow Show. Sorry it's not been the most active of weeks, but we can't do nothing about that. Get back into the football. We shall see you all tomorrow. Thank you very much.
Thanks, Ryan. Okay.
Cheers.
Cheers, guys.